Welcome to the Markets Policy Macrocast. Thanks for listening. I'm your host, John Fagan, joined as always by my partner, Brendan Walsh, this time from Steamboat Springs. We're all jealous.
No, not a bad
And
place to be.
yes, and you're up early for this recording. So that's your dedication to the Macrocast. And we're
Exactly.
joined today. We're fantastically grateful to have a Macrocast stalwart, a repeat contributor, John Dick from Civic Science. John, thank you for joining us.
Great to be here, guys. Great to be here.
Well, we thought this would be a good opportunity just to give you a chance to explain to our listeners what Civic Science is, what you do, and how you do it. So, yeah.
Yeah, happy to do that quickly. Yeah, I mean we call ourselves a consumer analytics company. We've developed a pretty clever way to gather and analyze like enormous amounts of survey research. I think we can say pretty confidently the largest sort of database of that kind of research that's ever existed. We have over 5 billion survey responses. We just crossed last fall. We'll do another billion this year, studying really. We kind of broke the economics of survey research a bit, which just allows us to kind of get to that kind of scale upwards of 3-4 million responses a day to our surveys. The vast majority of survey work we do is what we in the industry call syndicated, meaning it's not on behalf of a specific customer. We get to ask, we decide what to ask about, looking at things that candidly have the most kind of potential commercial value to the most potential interested parties out there. But over a decade now of doing that, that survey sort of refined itself into the things that we know have like the most meaning towards markets and brands and media, right? So thousands and thousands of those questions we've been asking nonstop since to 2011. So about 2013, we began exploring some of the kind of macroeconomic sentiment measures that are out there, Michigan Conference Board, and said, okay, could we do something, maybe a better mousetrap? One of the knocks on those surveys is that they're fairly intermittent, maybe done monthly, collected in a few almost arbitrary days in a given month. And so they often miss a lot of the undulations on a day-to-day or week-to-week basis in some of these things. So our economic sentiment index, which we normally talk about when we're together with you guys, is a daily read on a lot of those things that you would expect to see and some more, right? So of course we look at views on the job market and the housing market and a long-term outlook for the economy, but also dig a lot into more personal financial health measures like savings and credit and retirement outlook and so on and so forth. So, we do that because we know that those things, it's, James Carville said very famously in 1992, it's the economy, stupid, right? And yes, he meant that in the context of politics, but those things also turn out to be very, very predictive of not just like aggregate retail sales or restaurant sales, but you can even find a lot of nuance that's specific to a company like a McDonald's versus a Taco Bell, for example. So we're just a newfangled survey company, I guess. But with that sort of scale of data, we're able to kind of find patterns and frankly make some predictions about things just based on the history of the data we have. So.
All right. Well, let's dive into what it's currently telling you. You've got a new ESI reading, is that right, for this week?
Yep. Economic sentiment index came out. Our latest reading came out Wednesday. It was down definitely to a low point of the year. It's been pretty much sliding for the most part since the beginning of the year. 4 of our last 5 readings have been in the negative. There's nuances in there. Like in this particular reading, we looked at there's 5 primary metrics in the ESI: housing market, job market, major purchases, economic outlook, and then people's views of their personal finances. Views of personal finances has remained pretty resilient for going on a couple years, which is probably bucks some conventional wisdom given what's happened with inflation and rising credit card debt and student loan payments and so on. It had remained remarkably resilient. This last reading was the first time we'd seen that number fall appreciably. So I think maybe those things, that mounting credit card debt, buy now, pay later debt coming out of holiday, People have largely reported being dissatisfied with their tax returns, if not surprised with their tax returns. So they owed more than they expected or getting back less than they expected. So there's kind of a confluence of things that might finally beginning to show some cracks in the consumer.
And one of the things we've talked about in the past is divergence of sentiment based on party affiliation. I thought that was an interesting metric. And in the campaign season now, we've got the nominees have been revealed to us this week, as though it was a big surprise, but the campaign's in full swing. So what are you picking up on that front?
Oh, I mean, it's alive and well. In fact, a lot of the writing and publishing we've been doing lately is we talk about the three economies. There's sort of the Republican economy, the Democratic economy, and the real one, right? And it sort of depends on what news you read and whether they're catastrophizing or rationalizing. And this has been a phenomenon going on for a decade, which really, in some ways, has like dented some of the credibility of a lot of these macroeconomic measures, because the consumer is less likely to their economic outlook is becoming less and less about their real current financial state and much more about their kind of hope and fear born of whoever's leading Washington and their willingness to steer their ability to steer the economy. And then of course, like what media they read. And so Republicans since 2020, late 2020 have been reporting lesser positive views of the economy than Democrats have, right? And that was a flip-flop from what had happened when Trump was president. Republicans were more positive. So that has continued to hold pretty steady. Although I will say that a lot of the declines we've saw in the ESI this week, and really even the reading prior to it, was among Democrats. Economic sentiment has been falling at a faster pace than Republicans have been relatively steady. I don't know this to be certain, but we do think it has something to do with kind of the realization that Trump is going to be the Republican nominee. And I think there was a little bit of hope that wasn't going to be the scenario. And once that was sort of made official in the last, more or less official in this week, but really like last week, I think Democrats have just soured a bit on the kind of general climate. So still better off, still better view of the economy than Republicans, but it's getting a little closer.
And when you look at the demographics, how do things break out by age? Do you have anything in that area that's sticking out at you these days, or?
Yeah, I mean, younger people generally had been pretty more optimistic, I would say. Realize, these economics, us and Michigan and others, a lot of you're asking consumers like essentially forward-looking statements. Do you think the job market will improve? The housing market will improve? Those younger consumers, particularly younger left-leaning consumers, had been on balance more positive from an outlook perspective, which is a little ironic because they're also the same group that says in their current state that they're less financially secure. So again, sort of reinforcing that point that it's more of an emotional measure than a hard economic measure. And that's also one of the groups that in the last month has showed a steeper decline in their overall sentiment. A lot of that's driven by actual real financial fact, which is those younger consumers were the ones that spent themselves into significantly more credit card debt through the holidays, were more likely to be using buy now, pay later services. They're more likely to have student loan debt, right? So there is some real stuff when you sift through all of the emotion, but yeah, there's definitely a young and old difference. And also too, older consumers have been able to benefit more from the stock market, right? They've got more invested assets, more liquid assets, more probably deeper into the savings in their 401k. So they're whatever other economic headwinds they're dealing with, they're looking at their investment accounts and they're feeling pretty good about it.
Yeah, it's the intergenerational frictions here that it's an interesting time in terms of the attitudes toward inflation. Obviously, this is a key issue. You guys have picked this up and been focused on it. What are you seeing? Any change in the perception of inflation? Any differences over the past couple of months?
No, it had been pretty steady, and I think particularly the sort of personal finance metrics that we track. One of the reasons we believe they sort of stayed at a heightened level was because there was just this sense that inflation was getting better, and that as it continued to cool, then there was positive outlook that interest rates were going to come down sometime this year, and that actually explains some improvements in outlook we saw around things like major purchases in the housing market. There's reason to believe that the news of, say, the last few weeks has tempered some of that enthusiasm, which could also be a reason to sort of explain some of the less positive views of people's personal financial state. Like maybe we're not, maybe the light isn't the light at the end of the tunnel isn't quite as close as maybe people thought a month or two ago.
Yeah, this week's inflation data, and Brendan, you can speak to this in greater detail, but the market seemed to digest the CPI a little bit. There was a little bit of like whistling past the graveyard. It was a little bit hotter in the headline, but if you looked at the, if you throw this one out and the other thing out in the super core, and the owner's equivalent rent wasn't too bad, and that sort of stuff. But then the PPI, I think, came in and reinforced that wholesale price inflation number that came in yesterday, also hot. That has sort of a forward-looking component that those price increases tend to flow down into the consumer prices. What did you think when you saw that, Brendan?
I've been thinking for the last couple of months that the PPI is actually more important, not necessarily to the Fed, but to the reality of what's going on in the inflation world, because the CPI is a little wonky, and we've talked about that. But the PPI, is where you're going to catch those, like the situation in the Straits of Gaza, the Houthis keep bombing, the shipping containers. So now instead of going through the Red Sea, everyone's got to go around Africa. That's inflationary, and that's the first place it's going to show up is in the PPI reading, especially for goods inflation, where so much of the drop in the overall consumer prices of the last, say, 6 to 12 months has been a normalization of goods prices, but not even a normalization. We had actual deflation in goods prices after they got all screwed up in the pandemic. Now we're seeing, for the last few months in the consumer prices, goods have been kind of flat. But in his last reading, they actually were slightly positive. And it's then just kind of math. If you're not subtracting something and you're slightly adding to it, the overall number is going to be bigger, because service inflation tends to be just kind of more steady. It never doesn't really go down. It's just kind of a question of how much it's going to go up. So I do think it's not like we're going back to what happened at 7-8% inflation, but this last mile to kind of get back down to 2% inflation, it might be a little harder than we thought. And with the situation in the Middle East, there's nothing an economist or the Fed can do about that unless they want to strap on some drones and try to protect the ships.
Boy, this is the world we live in.
Those are things that really like escape the average consumer's understanding. I mean, hell, they escape my understanding, right? You guys are much deeper experts in this stuff, and I try to
everything I know about it.
Well, I try to look at these reports too, and it's always like, well, the headline says this, and there's like, oh, but there's good things underneath it, and then you try to like net out the good from the bad.
Yeah.
And then like sort of the average consumer, to the extent to which their sentiment about the economy is driven by what they read in the news, like it depends on what they read and who put the headline over top of what the headline was versus what the subtext was. Like I just, I kind of chuckled a bit. It was maybe sad, but still sad but funny. The February retail numbers, the sort of headline was February retail spending was up, but it seems like it was only up because they revised down the January.
Yeah, that happens a lot. Yeah.
Like, hey, great news. We lowered the bar in January, so now we're over the bar. So again, if the consumer is just looking at, the tweet where it's, oh, February retail sales rebound, like, oh, things must be good. You read the whole article and you're like, well, no, that's not really what happened.
Well, what really worries me for the Fed for the next 4 to 6 months is the wonky way that they measure housing is with a huge lag. but that lag is starting to begin to come into the reality that, you know, house prices and rental prices are down. And if you kind of take the, you know, the Redfin readings and things like that and extrapolate what the next 6 months of the BLS CPI reading is, you actually could have core like around 1%. That's how far behind the Fed measurement. But at that same time, you're still going to have this reality of sticky inflation that's much more important because that's real time. So, you know, the number that gets announced and, you know, people, you know, see on their tweets and things like that is inflation's, you know, falling off a cliff. But the reality in the world is it's actually that already happened, and we measured it wonky, and now the things are actually getting a little stickier than we thought. So that's a tough message to be able to explain to you know, 325 million people.
Yeah, and when you talk about, so John, when you look at a look across the data that we saw this past week, yeah, that retail sales number looked a little bit squishy. The inflation was a little bit kicky, but we saw another strong labor market indicator. Initial jobless claims, it was down again, and we just keep seeing these tallies on the month-on-month, you know, non-farm payrolls. What's the sentiment on the jobs front? Are you seeing any nuance? Are you seeing any cracks in the armor in the labor market?
I mean, again, pretty steady. Well, and it's look, it's not monolithic, right? It depends on sort of what job market you're in. You know, white collar tech types of jobs. I mean, there's still like headline layoffs and, you know, the big tech companies, and that's trickled its way into kind of, you know, Madison Avenue, as much as you know, the large brands have been kind of cutting some costs and things. So sort of depends on who you ask. But the, you know, the job market, the job numbers in the ESI have remained fairly steady, declined just a touch this last 2 weeks, but sometimes we can't really decouple all of those components. It's just like it's like the person we're surveying, like what mood are they in, right? And are they really sitting there and parsing jobs from personal finance, from debt, and so I would say a little soft over the last 4 or so weeks, but I would say that net, I think pretty just even. Again, there's just sort of like a tenuousness with the consumer right now. Like, again, there's such a mix of, you know, I think we coined it with you guys on this podcast, you know, months ago, this sort of like Long Island iced tea economy, right? It's like we just mix all this crazy stuff in it and you can't really taste anything anymore. So so I'm not sure the consumer is always great at like parsing individual elements of the economy, but job market, you know, people generally still feel pretty good about it if you're not in those like big tech layoff bands.
Yeah, because that's been interesting. You do see the headlines, oh, you know, Apple's laying off somebody, but when you look at the reality of it, it's not the tech geniuses that create the tech. It's so much the white collar jobs, and especially in like marketing and advertising. So where the headline looks, oh my God, you know, IBM's doing terrible, but the reality of it is they're just kind of reallocating assets. I mean, resources.
Well, and for the companies themselves, I mean, it's a boost for their stock price, right?
Yeah,
like
exactly.
They're increasing profit, so it's like for the company.
But you never hear, you know, Hilton's laying off, you know, a bunch of people at the hotels. You're hearing the exact opposite. You know, the service sector, medical care, they're still playing catch up to get back up to full employment for their needs.
We started studying this a few weeks ago about kind of just tracking like what consumers believe is most to blame for higher prices and inflation. Mm-hmm. And the answer choices are global economic conditions, U.S. economic and fiscal policy, general increased operating costs, wages increases, and so on, corporate price gouging, so companies just taking price where they can get it. And the number one answer by a decent margin is people blame U.S. economic and fiscal policy, right? And that might be a relatively uneducated point of view, right? We know the vast majority of these things influencing the economy right now are either current global situations or global circumstances 4 years ago that have just sort of led us to this place. But the average U.S. consumer doesn't think in a global way. They want to blame the the president or Congress for the state of things. Although second on that list is corporate price gouging. So there's definitely a growing sentiment among consumers that prices are high because companies have just chosen to make prices higher.
So I guess Wendy's didn't hire you guys to do a little preliminary survey about surge pricing.
Surge pricing.
I don't think they hired anybody to do that. Yeah.
Yeah,
that wasn't the best. Something of a ham-fisted idea.
Yeah, not great PR there.
PR around it.
So it sounds like, just to step back and sum up, so the consumer has relatively steady views on the job market, relatively steady views, all being equal. The relatively steady views on prices, a buildup in credit card and buy now, pay later debt is a little bit of a headwind on the consumer. What's getting bet on the positive side was expectations for rate cuts, being able to sort of boost the larger purchase intentions and so forth. Is there anything else that's getting better or worse for the consumer when you look at sort of the balance sheet of indicators?
Well, I guess it depends on your perspective. If you're a retailer, the good news is the consumer doesn't. We just published some data the other day about travel intent for the spring break and into the summer. It has not fallen at all over this time last year. So you would think, oh, I'm mounting all this credit card debt. I'm not going to get the tax return I expected. Maybe I'm going to like cancel a trip or something this summer. There doesn't seem to be, at least yet, the consumer making any of those kind of trade-offs. There are trade-offs happening where consumers are saying, like, I'm going to preserve my spending capacity in certain categories of quote unquote experiences, certain categories of retail like beauty and skincare, which seem to have been remarkably resilient. We're seeing them cut back on certain like household product areas like counter cleaner and Ziploc, things that just sort of maybe don't contribute as much to their emotional well-being as some of those other things do. So I guess it would depend a little bit on what category you're in. People are definitely cutting back at the grocery store. So they're eating more at home, but they're also cutting back on, buying smaller packages, buying trading down by brand, trading more to private labels. That kind of stuff is clearly happening. Whether that's how conscious or not that is from the consumer, it's just evident in the empirical numbers about that stuff.
I was always curious about that because, in the pandemic, you're caught at home, so you ordered a bunch of stuff, and then you were allowed to go back out, and you wanted to play catch up on the vacations that you missed and the meals that you ate out. And I was wondering how that would normalize if you're just kind of sick of going out to dinner. You've done it too much for the last 2 years, or like, I've taken too many vacations. We're going to take this summer off.
Well, there's in restaurant, there's some trade down behavior happening. People still want the occasion of going out to eat. I mean, this is why a company like McDonald's has just been so protected through all of this, because, right? I mean, when the economy has softened, all that it's meant to them is that people have gone from
new people are coming in the door
or Chili's, and now they're taking their family to McDonald's. So like the check sizes are actually larger.
Yeah.
Because they might be getting fewer visits, but they're getting larger check sizes because families are now coming to McDonald's instead of going to, Applebee's or whatever. So there's just a lot of shifting going on. Now in travel, what will be interesting to see is like whether now definitely like global, we're not seeing like international travel like we saw in 2022 when that
so that was a special,
that pent up revenge travel was being. But like the amount of vacation people are taking and the trips that they're taking seem to be on kind of on a pretty consistent year over year.
It's a steady, normal pace that you probably can bank on for the next couple of years.
Yeah, but am I going to drive somewhere instead of flying? Am I going to stay with friends instead of staying at hotels? Am I going to go camping instead of a resort? Like those things will, I think. I mean, we don't see it yet, but I think you could start to expect to see some of those shifts happen.
Yeah. And the other one I want to ask you about was work from home. So kind of for the first time, we started to see that pain reality come in the shares of New York Community Bank, which has a large exposure to, Manhattan office space. And if we don't go back to the office, that's only going to get worse as the leases come off and the buildings remain vacant. So I'd be curious to see what you're kind of seeing out there.
Well, we seem to have reached like something of an equilibrium with the current state of work now. The companies that were going to bring people back into the office have done that. The ones that aren't going to do it, I think, have sort of drawn, put that flag in the ground and said we're not going to do it. So, I haven't looked a lot at like commercial office like occupancy numbers lately, but I wouldn't expect them to go up or down very dramatically from wherever they are now. And also too, the consumers, or excuse me, the workers have sort of selected themselves into because there has been a lot of mobility in the workforce. So if I want to work at a place that doesn't require me to be in the office, I've found my way to that company by now, for the most part. Right now, notwithstanding non-voluntary job movements, but so if I think we can probably start to assume that we're close to like a new normal on those things, and it's obviously not anywhere close to what it was before the pandemic. So
that new normal means that there's a lot of obsolete downtown office space that is gonna, default. You got to figure it out.
Yeah, I'm not an expert on that stuff, but I would have to think that commercial real estate has, tough times ahead, because I mean, we have not required our team to go back to the office. We have a building in Pittsburgh, and we were able to, our lease we had happened to sign a 4 or 5 year lease like right before the pandemic, so we just got to the other side of it. And it was, let's just say, we had a lot of leverage on our side of the negotiation for our renewal.
But did you keep the same amount of space, or did you downsize it?
No, well, we ended up with the same amount of space.
Yeah, just for a lot less.
For a lot less, right? Look, for the landlords, occupancy is almost more important to them than revenue, right? Like, because they're borrowing against, and as they're getting, like, when people are looking at their balance sheet, it's sort of less about how much income they're bringing in and more about the spaces they currently own, are they occupied? And so there's not a lot of incentive. They don't want to split buildings in half and sublet and all that kind of stuff. So, but no, I think I believe we've reached a relative kind of sort of stasis or equilibrium with what in-office work is going to look like going forward.
Yeah. And let's close with some of the trendy topics that you're seeing, some things that that are still hot at the top of the consumer's wish list, and other things that are notable in your surveys. Yeah, I mean, we're paying a ton of attention to GLP-1s, Ozempic, Wegovy, just showing no signs of slowing, starting to see real impact in other parts of the economy as it relates to the use of those drugs. Some of them not, there was the narrative last fall, or someone said that they were seeing like shifts in like snack purchases and stuff like that. I don't think that, we have not seen that yet, and I don't think most of the snacking companies have. The one place where it is very, very real is if you're in the alcohol industry. Beer, wine, spirits, the users of these drugs are absolutely cutting back on alcohol consumption.
Yeah, that's the part that's missed. It's not just a weight drug. It's an urge drug, with urges, not just losing weight, so. Correct.
Yeah. So that's one that we're watching closely, because has lots of, that's not just like Bacardi and Miller Coors and so on, those companies, but then what does that mean to bar businesses and things like that going forward?
That's fascinating.
Cutting back on alcohol. Yeah. That's the first real evidence that we've seen of like economic, consumer spending shifts as among people taking these drugs. There's also, there's the group of people that are taking them now, and there's definitely people falling out of them, right? They start and then they stop. But the group of people that are like in the quote intender category, saying I'm not taking those drugs yet, but I'm thinking about it, that group's very big. And that group is also different from the groups that are taking it today. More rural, younger, right? And so if more of these drugs are being developed. There's more competition. Insurance companies begin to cover those drugs, so the prices come down, and it makes it more available to a larger swath of consumers. We might only be at the beginning of this thing. And I'll admit, I was a skeptic a year ago that like, oh, this is just another fad, right? Like keto or fen back, years ago, and it's not showing any signs of slowing. So that's definitely
no. I've read a lot on it, and we're really just at. This is the first easy step of like 4 or 5 more that we can take, from what we learned from this, so that there really in the next 10 years, even just 5 years, can be some pretty amazing breakthroughs in healthcare based on this path that they're going down.
Yeah, I mean, we forget how much of our economy is predicated on our collective obesity as a country, right? I mean, you get into medical devices like sleep apnea machines and knee replacement surgeries and all those kinds of things, that if 20% of this population is 40 pounds lighter, it's just wild to think about it. So that's definitely, there aren't many conversations I have with clients where that topic does not come up.
Fascinating.
That's a big one. And we're of course like just looking at how the machinations of the election cycle are impacting people's moods, and their moods then affecting their spending. And as you mentioned, John, at the beginning, like there's a pretty almost bifurcated views of the economy depending on which side of the aisle that you're on. And I think as we get closer to November, and maybe an outcome starts to feel more and more evident to people, will they start shifting their behaviors ahead of election day? Like, or are they going to wait for it to be official?
You might see an uptick in alcohol sales before the election.
Yeah, it could be. Yeah, maybe that's what. Maybe that will offset the Ozempic.
Yeah, that's right. Just the thing to fuel a comeback in the booze industry.
But what happened? What happened to the Pittsburgh sentiment after the Steelers signed Russell Wilson?
Haven't seen it yet. All I know is our Super Bowl odds went from 80-1 to 80-1. So
they're moving the needle there.
One last thing that I think is interesting, particularly I think for your audience too. People are paying less attention to political news right now than we've seen in 3 election cycles at this time of year, right? Like people are, I think part of it is everyone's just kind of sick of it. Like, and that's like political news consumption across cable news, internet, but also like the prominence of like people talking about politics on Facebook is like completely plummeted. I think like people have just sort of realized like this doesn't make me feel good, and it's not, I don't want to argue with my friends and family anymore. I'd rather just post my Wordle scores, that kind of thing going on. And then there's also, I think, just that particularly now that we, it's official, we've got a Biden and Trump rematch. It's like, what's the point? I know these two people. I've already made up my mind about these two people. I'm not really learning anything from following the news. So it's just like I'm doom scrolling or whatever. And so it's interesting the extent to which consumers are just sort of tuning it out. It's like significantly down from what we saw this time in 2020 and 2016. We don't have 2012 data like the same period of time, but yeah, the consumer is just kind of like, I'm over it. Nothing really to gain from it. I'd rather go spend my time, following news about Kate Middleton and the, whatever other things out there that are good distractions.
That story's getting better and better by the day.
Yeah.
Excellent. Well, before we fall down the rabbit hole of the Royals, let's call it a Macrocast. John Dick from Civic Science, thank you so much. The most, I think, certainly of all the guests with the most Macrocasts under your belt, still going strong. We always learn something new from you. Thanks so much.
I love it. I mean, I always say this. I always feel like I learn from you guys on these things too. Like your particularly your perspective of like sort of the global marketplace. As much as I sometimes get frustrated that the U.S. voter, the U.S. consumer doesn't really think about our relative strength compared to the rest of the world. I sometimes get myopic about what's going on here. So I always feel like I'm learning something from this too. So have me back. I'd love to come back anytime you need me. And
you are booked. If you want to, let's keep the same schedule.
Monthly booking.
Count on it. I really enjoy it. So it's a great way to start off a Friday morning too. Like
Exactly.
Good way to head into the weekend. So, all right, fellas, thanks a lot.
Thanks, John.
All right,
and thanks
have a
to all the
great weekend.
listeners. We appreciate it. See you next week on the Markets Policy Macrocast.